Okay, I think we should make a start. Good morning to those of us in Europe and the UK. Good afternoon to those of us in the Middle East. My name is Richard Banks. I'm an advisor to M7, and I have the great pleasure of being the moderator for today's webcast, which is about how Middle East capital is looking at investment in international real estate, particularly in the UK, although I think we're going to talk about Europe and about maybe a little bit about the US later on. I have to do a quick disclaimer. So this webcast is for information purposes only. We are not offering any form of investment or transaction advice. M7 and Camco Invest comply with all the appropriate regulations in all the jurisdictions in which we operate. Please see our websites for further details. So with that out of the way, I would like to introduce our three guests on this joint Camco Invest and M7 webcast. We have Richard Croft, who is Executive Chairman of M7. He is coming to us live from snowbound Suffolk with his wonderful fireplace behind him and his enormous microphone in front of him. Richard, very good morning. You're still on mute. You can unmute yourself.
I was just trying to unmute myself, and thank you for pointing out the microphone. It is indeed perfect.
Well, it's good. We can hear you very well. That's the important thing.
That's the whole aim of this.
Also from M7, from his personal office in deepest, darkest Tunbridge Wells, is our Chief Executive and former CIO, David Eberl. David, good morning. Nice to see you.
Good morning, Richard. Great to see you as well.
And last but by no means least, from our partners Camco Invest and the hosts of this, also Camco Invest, in Kuwait, Mohammed Al Othman of Camco. Mohammed, for those of you who don't know, and I think all of you will, is the head of real estate for Camco. That's right? I've got that right, Mohammed?
Yes. Thank you, Richard.
Maybe?
I'm thinking about it still. We'll see.
Anyway,
thank you, Richard, and good morning to everybody, and good afternoon as well.
Well, look, let me just say personally, it's great to have all three of you on this webcast. As you all know, we are all friends of mine. We've worked together for many years in many different forms, and it's a wonderful privilege to have you all here this morning. I want to start briefly, given that the majority of the audience for this webcast is in fact from the Middle East, just to have Richard Croft introduce who M7 are and what M7 have done, are doing, and will do. So Richard, why don't you give us a little portrait of M7?
Thank you, Richard. M7 is a pan-European investor and asset manager in real estate, and our focus has always been on slightly higher yielding real estate, because we think the majority of returns in real estate should come from income, and then the capital value takes care of itself. Today we manage between 4 and 5 billion of assets across several jurisdictions, but we have offices in 14 countries across Europe, and our largest office is in the United Kingdom, where obviously we have partnered with Camco on a number of strategies, but the most important being regional offices. So let me explain our focus. We always look at house for a number of things, but most importantly of all, we try to find sectors in real estate where we think that the occupier market has got more demand than it can meet supply. So historically, we were big investors in industrial real estate at a time that other people didn't want to. And then we got into sectors like Dutch offices, where there was actually quite strong occupier demand, but very little investment demand. And at the moment, we have two primary investment strategies, one of which is what we call Ewarehousing, which we'll talk about later, and one of which is regional offices, which we've been doing with Camco. And just to explain the regional office concept, particularly in the UK, but also elsewhere in Europe, one of the things that we have noticed post the pandemic, that is not going to the office that's going to be a thing that evolves as a result of the pandemic. In fact, everybody I speak to cannot wait to return to the office. As much as I like being in front of my fireplace, I cannot wait to get back to work. The issue really is going to be the long distance mass transit commute. one of the things that suddenly is less appealing is commuting at 6 a.m. every morning to the same place, particularly if you could work more locally. And what we've learned from the pandemic is that work from home doesn't mean work from home, it means work near home. And remote working doesn't mean you have to do it at home, you can do it anywhere. In fact, most of us on this call have probably been working remotely for most of our careers, or certainly for the last 10 or 20 years, because technology has allowed us to do so as we travel. So our view is that the regional office market is likely to improve in occupier terms, A, because of affordability, B, just because of developing trends from the pandemic. But at the same time, a lot of the markets that we've invested in, particularly the markets we've invested in with Kamco, where we've got long leases, good quality tenants, we're still buying at levels of investment that are below construction cost, and that's really important because it means that there is very little opportunity for other people to come and build to provide more supply to a market where there is increasing demand.
Great, thank you, Richard. That, as always, it goes in, it begs more questions than it answers, but we've got time to answer.
I'm here to answer any question.
I know, and that's what I was going to say. So, to our audience, which is fantastic, we've got well over 100 people here, which is fantastic. This is an interactive session, and we're not going to talk for 45 minutes and then give you 15 minutes for questions. We want you to ask questions throughout. All of the panelists have the questions and answers box open. We can see them, so please do ask us questions, and all of us will endeavor to answer them to the best of our ability. And you can do that immediately, and you can ask a question about anything. If we can't answer it, we'll probably just make something up that sounds credible. Mohammed, I want to come to you next. Could you just tell us a little bit about Camco Invest's real estate operations? I mean, we'll talk a little more detail. I'll ask David to talk a little bit about the relationship between Canco and M7, but if you could give us the sort of bigger picture, as I know that there is more that you do as a firm, and that you have wider strategies and ambitions for the asset class.
Yeah, sure. Thank you, Richard. We here at Camco Invest, we've started what we called our international real estate platform towards the end of 2015, beginning of 2016, with the focus on international real estate on the largest markets in the world, which are the US, the UK, and continental Europe, mainly in Germany. We have adopted a strategy that preserves the capital, protects the capital, and enhances and delivers the decent returns that our investor base are looking for, which was basically built on single tenant long-term leases, being the tenant investment grade. We have transacted over the past 5 years, over 15 transactions, and focusing on that strategy. We have also been working on developing, as Richard has mentioned earlier, the relationship that we are very happy and excited about with M7, focusing on the regional offices, which diverts a little bit from our core strategy into Core Plus, which is focusing on the regional offices where there is the potential of the extension of the lease, or as well as probably re-tenant the buildings. In that strategy, our entire focus was on two sectors, which are the office and logistics and industrial. I also concur and agree with Richard, what he's mentioned earlier about the office space and the demand and the need for office space. We actually think because of COVID and the pandemic that we have went through, we believe will continue to if anything, it has been enhanced. Though office space and the design of an office will be different, as well as the flexibility will be more relevant prior to the pandemic, where everybody needs to work from 9 to 5 every 5 days a week. That might change, but the need for an office will remain to be there.
Do these themes play out across all of the three geographies that you mentioned? You talked about the US, you talked about the UK, you talked about the EU, and we're going to go on to be a bit more granular about the UK and the EU markets. But do you see the same trends in the United States in the transactions you're doing there?
Oh yes, absolutely. It's more so to also the less gateway cities, more into regional markets and regional cities, like what we are doing with our friends and partners M7 in the UK. We've been looking at assets, we've transacted in assets where the tenants actually have signed their leases in the midst of the pandemic, which was signed around July, August in the US, July, August of 2020 in the US. So we see this to play out and will continue to be, and they've also signed long-term leases, 10-year plus. That's why we think that this will continue to be the dominant, or not dominant, but will continue to be relevant in the near future.
Thank you, Mohammed. We'll come back to those themes. In fact, a number of people have already asked questions that I think touch on them, but I'd like to bring in David now. David, you are, amongst other things, the sort of custodian of the relationship with Camco Invest at M7. Why do you think it is that there is still value in this regional office strategy? And do you see that value continuing over the future? We closed the second transaction with Mohammed and his team a week ago today, I think. Yeah, it was.
Yes, it was. So it had to be the third.
Just another point is that you've never, I mean, you know, you've done two really excellent deals with Mohammed, but you've never physically met, which I think is an incredible thing. And I'm looking forward to the day when you do. But tell us a little bit about that background and where you see that going over the next 12 months.
So look, I think the relationship that we built as M7 with Mohammed and the wider team is one that again, was started with a series of face-to-face meetings. Richard and Mohammed have met separately. I've met Faisal, but again, we've never really all met in the same room. Zoom has been something that has definitely helped keep the relationship alive and kind of thriving during the last 12 months. But I think it never really replaces that kind of face-to-face interaction. But it's a pretty interesting proxy. And I think that the way that our relationship has worked is that we've seen definitely a relatively unique opportunity, I think, to sort of access some kind of mispricing that we're seeing in the office market and be able to work on that with Mohammed and Mohammed's team, I think has been something that I've really enjoyed and appreciated. And I think we, in terms of M7, and I think Kamco agree, I think what we are kind of looking at is very much value add kind of pricing for what we see very much as core plus returns. And Richard talked to Mohammed also about kind of that supply and demand kind of dynamics. I think down to occupier outside of the development piece, I think when we're looking at regional UK, I think we're still seeing a market where over 4 million square feet of offices were taken up during the course of 2020. So that definitely isn't no activity. It has been subdued, but there's definitely activity there. And these are in markets where we've been targeting, where sort of, again, supply rates are sub 10%. In the Southeast, that number is more like 7%. And I think in terms of when you kind of break that supply down further, what we're seeing is good quality, these kind of grade A buildings, which we're focused on. These are where that level of supply is even less. So it's a really thin space. And I think where we feel very excited about this with Camco and the opportunities that we're looking is that ability then to kind of grow those rents in the medium term. I think where we're seeing things from an occupier perspective is that I think that we see that the office remains a very key part of every business's kind of DNA. That kind of collaboration, I think, is key, and the office will continue to foster that. I think what we've seen in other markets, and perhaps looking at the Netherlands as a bellwether for occupier behavior. In the Netherlands, they've had a much higher degree of the office workforce having this kind of flexible working, where over 35% of the workforce pre-COVID had the ability not just to typically work your Monday through Friday 9 to 5. And what we saw in terms of that trend in the Netherlands is the kind of the de-densification of the workspace and the kind of the increasing sort of focus, whether that be on your own sort of collaboration space within your office or that collaboration space within the multi-tenanted buildings as well. And that, I think, is how we foresee the office market to be looking and performing, and why we think from a yield perspective, we still think we can get a very interesting cash on cash return based on the assets that we're able to buy and the opportunity set that we're seeing. So I think we are cautiously positive regarding the prospect for further office opportunities.
Now, the work that you've done, particularly with Mohammed and Kamco, has been in the UK. Are these market conditions extant anywhere else in Europe? I know that the firm is working on a number of strategies, but is that, could you say the same thing about maybe Dublin or Amsterdam or Utrecht or somewhere like that?
Yes, I think, Richard, I think in short the answer is yes, we definitely can. And these are markets that, again, we have an office there for at least kind of 8 years. So we have a deep presence and understanding in terms of these specific occupier dynamics. And I think that what we're seeing, if you move out of prime CBD assets in the gateway cities, I think as soon as you move back, you have very similar supply-demand dynamics. You haven't seen that huge amounts of development. We've got limited amounts that we're seeing throughout the whole of the UK. But you're seeing, again, a sort of demand continuing in these kind of locations. So I think in all those cities that you've mentioned, we are seeing similar interesting dynamics. And I think that again, the occupier, as long as we've got that kind of supply and demand balance correct, then I think that's something that I think continues to present interesting opportunities, especially with an interesting yield attached to it.
Richard, we have a number of very good questions that I'd like to sort of throw into the mix. And at the risk of red rag in front of a bull, I'm going to ask the first one, which is from an anonymous attendee, which says, where do you see the opportunities in UK real estate post-Brexit? Let me unpack that question into two parts. First of all, what impact, if any, has Brexit, as opposed to COVID, had on the UK real estate market? And secondly, either related or unrelated, what other opportunities do you see in the UK beyond the regional office strategy that Mohammed and David have been speaking to?
Right, let's just deal with Brexit first of all. I don't think anybody yet knows the actual outcome of Brexit. I certainly don't. As you know, I'm a keen student of the subject. You've seen things like JD Sports say yesterday that Brexit has been much more complicated than they anticipated, which we've seen the impact it's had on the fishing industry. But there are a lot of industries that remain unimpacted to date. I mean, like all things, I think I've been well documented that I don't think Brexit is a particularly fabulous outcome, but it's happened. Will the UK collapse as a result? No. Does it lessen its standing in the world? I think personally, yes. But it remains a very important economy. It remains an important country. So the reality is I think it takes a little bit of shine off the country, but it doesn't alter a lot of the rules.
Oh, Richard, we have it's a little difficult to hear you. So maybe do you want to?
How about that?
That's much better. Yes.
So I was just saying that I don't think that Brexit creates a lot of change to the real estate markets. It is going to change the opportunity set, though. So I am slightly contrarian, relatively bearish London. I don't think London is going to collapse or anything like that. It's going to remain the dominant city in the European continent. But its absolute dominance is probably coming to an end. And I think it's probably gone ex-growth. And what I mean by that is, London is very, very expensive, and that's fine for the very wealthy. But for everybody who comes in to provide the services into London, it becomes very difficult to find somewhere to live. The general cost of London is about 30% above the other cities in the UK, and that is having an impact. You then layer on COVID, the lack of mass transit commuting, and then this need. I think people are going to have to work closer to home. I think it points to a better investment opportunity in regional UK than it does in London. Now, that doesn't mean to say that London will still not have the best places to be and still be the dominant city. But if you are going to set up a new office in the UK, you can have a small office in London. and then maybe look at Birmingham or Manchester or Leeds. It's very quick to get into London, particularly Birmingham. And if you look at it, it is about 1/4 of the cost. And here's some interesting dynamics about a city like Birmingham. Birmingham is a city that has 5 major universities, 5, very, very large student population, 50% of whom stay in Birmingham. Now that, London can't compete with that. And the reason that that's the case is people can afford to stay. Whereas London, if you're a student, you first go, it's tough. And that doesn't mean to say that London won't be a major international city, it will. But if you're buying an office building in London off a 3.5, 4 cap, of rents of 80, 90 pounds a square foot, it doesn't take a massive leap of faith to look at something, let's say in Birmingham, where the rent is maybe 22, 23 pounds a square foot and the yield 6, to look at that and go, there is more prospect for growth both from the yield perspective and from the rental perspective than there is in London. So, am I bearish London? I suppose probably better say that I'm neutral. But I think what Brexit does, it also means that the government is more committed than ever to this levelling up strategy, which you've read a lot about, to protect the red wall seats, which means there is going to be massive fiscal stimulus into the regions through infrastructure spend over the next 5 years. The British, that's the Faustian pact that the British government has entered into with the people that have lent it its vote. And as a result, I think, government investment into the regions is going to be greater than ever because it has to be. And, so I'll just finish here, that the cost of money is so low, interest rates are naught and will remain naught for a considerable period of time, that actually there is a magic money tree of sorts, because cash is deflationary, which is going to push a lot of money into the regions and almost certainly result in a substantial uplift in asset prices. So, Brexit, does it improve Britain? No. But does it mean that more investment will be made into the regions as a result of the Faustian pact the government entered into to deliver Brexit? Yes.
Okay, thank you. Mohammed, when you talk to your investors, what is their perspective on the UK? I mean, if you look at the macro events that have hit the UK in the past couple of years, Brexit and COVID, the possibility, you're on mute by the way, of Scottish independence, there's a lot of quite large structural themes that would, at least on the surface, increase people's perception of the UK risk, whether that's in London or in the regions. How do your investors see the UK, and has that perspective changed at all over the last couple of years?
Yeah, sure. Our investor base, we come from this part of the world where there is some sort of emotional connection to the UK. More so specifically in London, but generally also in the UK. So there has always been this connection with the UK and the UK market. Also, most of our investors are savvy when it comes to real estate investments. Now, we have found a concern with our investors back in 2016 and end of 2016 and 17 when the referendum was going on and the results of it. Just like the US elections and the referendum, everybody was expecting just one day, let's get it over with and everything will be back to normal. When the result came back differently, investors were a little bit cautious and concerned. But since then, we have found that their investment appetite when it comes to the UK remains strong. We were going through an acquisition at that time in the middle of the referendum, to be more specifically also in Scotland, where there was the referendum in Scotland where they were to be separated from the rest of the UK. It was going through. The concern that we had was there and it was valid, but nonetheless, investors committed to the investment and then they invested in it. So we still see that there is a strong and healthy appetite for UK investment, and we think that this is here to remain.
Good. Thank you. There are some extremely good questions, as I said. Let's pick up one from a gentleman at Action Group, who is about probably to David, I think. Well, it's addressed to Richard, but I think the question may be for David. It says, Richard, hi, I get the logic behind your strategy for regional offices. Do you think that the long upward-only leases that traditionally have dominated the UK office market will remain, or will demand become more short-term, flexible, possibly with break clauses, and no upward-only leases? David, would you like to comment on that? Or Richard?
Yeah, I'd be happy to. And look, I think we're going to probably see a mixture. I think there's definitely an occupier desire for a bit more flexibility in terms of leases. I think in terms of the way that people are pricing and the way that the real estate markets are valued, if you don't have that particular sort of length of certain leases, I think what you're going to see is that there's going to be a premium that they will be seeking from a tenant in respect of that. So I think from our perspective, I think we've seen the traditional UK leases definitely start to reduce from being sort of 25-year, very landlord-friendly leases at the very beginning. I think what we're seeing now is that a 10-year lease is now very much more the norm, especially in the office sector, with probably then flexibility around what happens at year 5 from a break perspective. So I think we'll start to still see that, but I think the important thing is with tenants is that, again, and we're a great example with M7 in the building that we occupy in London. Again, the amount of fit out that you need to commit to these particular buildings mean that you're not really looking to kind of change office space every 2, 3, every 5 years. So I think from our perspective, that longer term lease, I think, remains a likelihood in terms of 5-year and above on the office side of things, unless you're going for the very, very flexible model. And I think in rent reviews, I think it's going to be very unusual for us to have that downward level of review at that particular point in terms of the lease position. I just don't think that's something that landlords are going to be really that willing to have on a mark-to-market basis.
Mohammed, I'd like to sort of flip the perspective on that question and also include the question of one of our another anonymous, very shy, or our attendees today, and sort of frame it like this. The anonymous attendee basically asks, traditionally Middle East investors are looking at 7 to 8% cash on cash in core plus, assets in maybe not gateway locations, but in good, strong locations, strong tenants. That those types of assets are in short supply. Are we seeing that the Middle East investors' sort of risk appetite or risk spectrum is widening, and in what way is it widening? Are they willing to accept a lower yield, or are they willing to take more risk? And how, if what David says about the way that leases are changing, do you think that your investors will worry about that change in lease structure in the UK particularly?
Yeah, actually, the answer to the second part of the question, where there is on the leases, there is a worry, and they do ask these questions, and they have the right to be concerned about them, but they also trust their partner that they are investing with, and that they know what is the expectation for such a lease and for such an office and opportunity. Now, to the first part of the question, yes, there has been a shift with the markets, with the investors' demand for return, primarily because of the low interest rates that are prevailing currently in the market, and the return on as compared to fixed deposits that they can generate, or fixed income instruments that they can generate return on. Now, we try to, with our partners M7, when we present an opportunity to our investors, that we show them what are the comparables and what is available in the market, and what is this investment opportunity is bringing to you, and how does it compare in terms of risk return profile against other opportunities in the market? So if this does make sense, and it usually does, they are satisfied with the feedback, and that they are and with the opportunity. Hence, what we have seen in demand and in appetite and the opportunities that we have been showing our investors.
That's interesting to hear. I mean, we hear that too a little bit of. I mean, it's the core thresholds are still there, but there is a willingness now to entertain different ideas to get to that point that wasn't the case 18 months ago. Richard, I want to come to you with a sort of hybrid of a couple of these questions. Hassan Baid asks about the fundamental cause of the 2007-2008 financial crisis was misallocation of credit to the real estate market. How are government policies any different now with the Bank of England rates next to zero?
There's a massive difference between 2007 and this crisis. So, by the way, is my speech now audible?
Yeah, I can hear you much better, but yeah, you need to stay close to your.
No, it's actually I fixed the microphone. It was
great.
The driver issue. Anyway, the fundamental difference between the global financial crisis and this was the global financial crisis was a global liquidity crisis. Okay, a totally different position to we find ourselves today. So today we have a global economic crisis that is being hidden by a total lack of global liquidity crisis. I mean, we've got more liquidity than ever. The reason why the Nasdaq is at the level that it is, the Dow. I mean, London Stock Exchange is a bit different because it basically has no new businesses. It's only got miners and banks and airlines, which to be honest are not wildly popular at the moment. But almost all stock markets are at record levels, and that doesn't represent the economy anymore. But what it does do is represent Katrina. You say, who is Katrina? Well, Katrina is keep acquiring. There really is no alternative, because the real value of cash now is, or the real return value of cash is zero. Actually, it might be less than zero because the genuine risk-free rate of investment is now negative. There is over 20 trillion, I will repeat that number, 20 trillion, I mean, it's so big I don't even know where to begin with it, of sovereign debt that is either zero rated or negative rated. So if you believe there is more liquidity in the world, and there is going to be through quantitative easing and fiscal stimulus, then the reality is that asset pricing will go up, whilst the real economy probably won't have any inflation in it, but there will be asset inflation. So in answer to the question about what's different this time, the difference is liquidity and also interest rates. Because if you take our experiences, so David and I experiences during the global financial crisis, what caused us problems, and they were severe problems in 2007, 8, 9, was we'd swapped all our debt, as we were required to by the banks. We hedged all our debt when interest rates were 5%. Interest rates collapsed pretty much overnight to 1 and then 0. And we were all left, almost every real estate investor, not only with a lack of liquidity into real estate, but substantial swap rate liabilities. This time, that can't happen because interest rates are effectively 0. Well, they're not effectively, they are 0, or in some cases, negative. So there is a different set of dynamics this time. Now, I happen to believe that in the next 5 years, you're going to have a golden era for real estate, and where real estate will decouple from the real economy just because it's a real asset and it's got real cash flow. And if you work on the concept of real estate being an income-producing investment, work on the basis of rent before dividend. And what I mean by that is if you invest in Shell, let's say, to get its dividend, you're better off buying the real estate that Shell's in because it has to pay that right at the top of the income waterfall. It has to meet its rent at the same time as it meets its salaries. So dividend is paid out of profit. So at which point, it's better to invest in real estate. And I think, real assets that can be touched, that can be, understood, I think have got a very important role to play in the next 2, 3, 4 years. And what the pandemic would also do is reduce the rate of development which will make standard investments look more attractive. So I think that the next few years are actually going to be incredibly kind to real assets, particularly real assets that produce an awful lot of income.
Thank you. I'm going to go on to, there's a number of questions about debt, but including one from our old friend Phil Chamberlain. Hello, Phil. Good to see you. That you are there. Quickly, David, inflation. Richard's talked about it. Is inflation a concern, especially in the UK?
I think at the moment, I think given where we're seeing things, I don't see huge amounts of inflationary pressure currently. So I think the answer is no.
Can I double down on that and say there are two different types of inflation? There's market inflation, real economy inflation, which there is limited risk of that. I'll explain why in a second. And asset inflation, which there is going to be plenty of. Because there is so much liquidity that is chasing a limited pool of assets, there will be asset inflation. But the real market has become so efficient that basically inflation is caused by excess demand over supply, economics 101. But in the real market, where you have excess demand, the market can meet the supply very quickly. And it's done it. I mean, you can even do it now with oil. So if you think back to the end of the financial crisis, raw materials should be, almost immune from market forces. However, what happened is when oil got to $150 a barrel, we found new ways of digging it out of the ground, so there was more supply. The concept of peak oil has ceased to be a thing, I think. And what's also happening is there's more and more money being invested in clean energies as an alternative to oil, because oil just got too expensive. And so now we've seen oil sort of float around $60 a barrel. You strip out March and all the nonsense around March and April last year. So it has found the rate that is the world is prepared to pay for it. But as a result, there's been very little oil inflation for a very long time, because the market, as soon as there is excess demand, finds a way of meeting it. And that's true with almost any raw material or any manufactured good. Can you think of anything where real inflation has real inflation has been running at 1 or 2% now for probably 10 years, and deflation is a much bigger risk in the marketplace than inflation. And to be honest, a little bit of inflation now probably wouldn't be a bad thing, but I think the risk of it is very small. But asset inflation is going to be substantial.
So own an asset.
Yeah, I mean, all right, I'm in danger of talking our own book, but yeah.
I think we're allowed to talk our own book. That's the point.
It's why we're here. But yeah, I mean, it seems inconceivable to me that there won't be meaningful asset inflation, and all the evidence that is in front of us at the moment is that assets are being inflated. Bitcoin at $50,000 of Bitcoin, Dogecoin. I mean, and that money is just finding its way into anything that can produce a return, because cash is currently deflationary.
Rocket. We were talking about this before. Mohammed, other than your Dogecoin holdings, I have a couple of questions for you before we come back to talk about the side of things. M7 does have a very strong debt team led by Hugh Fraser, but he's not here. But we can talk about that in a minute. But there are a couple of questions specifically addressed to you, Mohammed. So let me ask them. One of our other shy attendees asks, what role does Camco play in the investment process with M7 beyond the Sharia wrapper structure? And the answer is, I know, because I've done this with you a lot, but maybe you could sort of explain to our audience how that relationship works, what is the role of each of the parties, and where you particularly your team comes in.
Sure, absolutely. Again, like what we've discussed a number of times with you and I, Richard, and also Richard, David, and myself, and the relationship between Camco and M7 is a partnership relationship. That's the essence of it. We participate as Camco team with the M7 team, going through the relevant due diligence exercises on any transaction that is being discussed or assessed. We also go work on the lending side with Hugh Fraser and his team on selecting the best lender, as well as working with our legal counsel from the beginning of the transaction up until the last moment when we do the acquisition. That's basically in a nutshell how we work as Camco and M7.
And your team is responsible for developing, along with the M7 team, the business plan for the portfolios, and then implementing that business plan over the life of the hold as well. It's by no means a sort of fire and forget type of organization. The real work starts once you acquired the assets in many ways.
Yes, again, absolutely, you're absolutely right. Putting the business plan is just assumptions on an Excel sheet. Does it work or it doesn't? That only time will tell. But we do the assessment and we do the discussion and we do the grilling between ourselves and the teams, between the M7 and the Camco team, discussing all the assumptions in any business plan that we subscribe to. Then we continue the real work, as you put it, which is true, on the asset management that the M7 team are very well known of, and to basically putting and making sure that that business plan that we have agreed to is working as we have discussed it and agreed to it.
Excellent. So let's go on to the debt market. David, I'm going to pull together Nasser Al Khalid's and Phil Chamberlain's questions. Nasser asks, what is the current status of the debt market? Phil, a little bit more in our face there, says, what difficulties have we experienced with debt lenders in respect of value-added strategies? Well, none, of course, because of the brilliant Hugh Fraser. But tell us a little bit about how you've seen the debt market evolve in the last 12 months, with specific, perhaps examples with the Canco transactions. Who are you talking to? And also, and Richard, you can come in here, of course, as well, is to talk about Hugh's real estate debt lending business as well, because you're active on that in addition to the equity side.
So if I start then in terms of the lending environment that we see ourselves in,
yes.
I think as soon as the COVID was really taking hold, I think what we saw from nearly all lenders was kind of everyone taking stock just to try and really understand what was the book that they had lent upon, and trying to understand where they were sitting before they were then really turning their attention to new lenders or to new lending. I think part of the way that we've tried to react to that from an M7 perspective is to be very transparent with our lenders. So across the very beginning of seeing the kind of shift in terms of what was happening, trying to give lenders visibility in terms of what M7 was seeing across its portfolio, whether it be about a specific loan that a lender would have, or whether it be about the wider M7 platform. We found that the kind of information sharing and transparency was the key thing, and that goes to one of the key lessons that Richard and I took away from the kind of 2008 and 2009, is that, again, transparency, to be able to show exactly what is happening in your portfolio, means that you are a lot lower down the list of where people are seeing potential problems. So I think that's the first thing that we definitely witnessed. And I think we were very quick to give that level of transparency, not just within a particular relationship with a lender, but across the M7 platform. And then when we started to then think about approaching lenders for our first assets, which we concluded during Q3, we were able to draw from the existing kind of behavior of our portfolio to give real-time examples in terms of what was happening, whether that be for rent collection or for leasing activities that we were seeing. So I think what we saw was a narrowing of lenders that were looking to be active in the space. But again, it wasn't the case that we only had one particular lender. We had a number of parties that were very keen to look at the opportunity. And I think sponsor quality was a very big part of that, not just with M7, but also in terms of Camco and Camco's reputation. I think as that kind of combination of a sponsor, I think that again helps significantly in terms of kind of trying to secure the best terms. And I think to Phil's point, I think sponsor quality is the key thing. And I think then what we saw when people were then looking at the different terms was again, some of the terms were not necessarily as accretive as others. And it's trying to get that particular balance correct as a result of kind of debt proceeds versus margin versus amortization, just to try and get the right risk return balance and also flexibility ultimately for Mohammed and Camco Invest's ultimate sort of investors. So I think that's kind of how we saw that particular part. And we had sponsorship on the first portfolio that we acquired together, where we bought 3 assets. And I think it's important that these are 3 separate transactions. So when we've kind of started to pull this together and working with Mohammed and the Camco team, this has not been buying particular portfolios. We found deepest value by buying individual sort of opportunities and working on which we think offers the best risk-adjusted return. That first kind of 3 assets were funded by Aviva. And they also, again, in terms of the positive of that nature of that relationship and that lending, Aviva also then lent to us on the second facility that we drew down last Wednesday for the Riverside portfolio.
Excellent. Mohammed, before I ask Richard to talk about Hugh and his team, any comments on the debt side of things and how that's been for you, not just with M7, but with others over the past year or so? Have you seen the changes that David alluded to?
Yeah, absolutely. No, absolutely. It's but we also, I'd like to add that we've always received good feedback from lenders, given the nature and the risk associated with the opportunity. There always has been lenders that are willing to lend. We've come across that. It's just to, as far as we're concerned, we're trying just to make sure to get the best terms for us and for our investors. But we've never been in a situation where there is no lender is willing to, we let go of an investment where there are no lenders that are willing to lend. So it's just a matter of picking the right one. And as David has said, we've worked with Aviva on the earlier portfolio. Also on the second one, there were Aviva and somebody else that were coming, they were shortlisted in the final, but we've chosen Aviva for obviously for the terms that we have received, in addition to the fact that we've known them and we are also building a relationship with them as well.
Excellent. Well, we've got about 12 minutes left. We have some absolutely epically good questions, I think, to answer. So I'm just going to fire them at you. Sorry, I said to Richard that we should talk a little bit about Hugh. So Richard, could you give us a thumbnail on Hugh Fraser and the M7 Capital team?
And I get the point that still a couple of people are struggling to hear. Are we now? Is it all coming through loud and clear?
Yeah, I think if you sort of speak a little,
louder. I need to shout. Anyway, well, so I'm going to shout about Hugh because he's well worth shouting about. It's worth noting that since the pandemic started, somebody's just messaged me, said shouting much better. But since the pandemic started, we have achieved, I think, 11 new loans, including new relationships, obviously, with Canco, with Aviva, but we've also, in Central Europe, we've done a new deal with Erste Bank. In Europe, we've done a new deal with BAML. We've obviously, in the UK, recently done loans with Aberdeen Standard and with Apollo. And we've done deals with Starwood Property Finance, so a wide range of banks. But the thing is, one of the things that we are spotting in the market at the moment is if you are a well-known manager, and we fall into that camp, then debt is available. I mean, it always is, because it is the banks and financial institutions will lend to those that they feel comfortable with. What we have seen, though, is a market opportunity in regional UK for small balance loans. Because one of the things that has happened since the global financial crisis was the FCA has got very tight on bank lending. They don't want the banks to lend 95% again and call it debt, because it's not. When you lend 95%, you have an equity position. So basically, regional small balance lending has become uneconomic for the banks to make because of a strange piece of FCA legislation called slotting. And so we've set up a fund actually to provide loans of up to 70% LTV for they tend to be about 65% LTV, into the regional real estate market, because we're able to underwrite assets in a way that banks can't. Because, to be honest, I think we're one of the best investors in that sector. So we have our real estate team underwrite it. So we would only lend if we feel comfortable with the risk. And effectively, we offer our investors a 10% coupon. And this is run by Hugh, for money that sits between 52 and 68% in the cap stack. It's got no capital growth, obviously, but it's a listed loan note, which effectively is a mezzanine fund, albeit we have control of the whole loan. So that's an opportunity that we see and will exist for the next few years. The Hughes team, as well as running all the debt program for our traditional real estate funds, is also running a debt fund.
Excellent. I'm sure well, I know we're going to do more on that in our other webcasts later on.
I'm looking forward to it. One of my favorite subjects.
It is, and Hugh is epic, and we love Hugh.
Yeah, absolutely, I have to say that, Hugh and Payal, and he's promising us an amazing time the next time we see him in Amsterdam.
We are very much looking forward to multiple Camco dinners that will happen in various different capital cities the world over. We're going to be quick, so I'm just going to go from the top. David, could you talk about, does M7 structure real estate funds? Could you give us a thumbnail on the M7 funds?
Yes, we do, and we tend to have a series of funds which perhaps are a little bit more risky and a little bit more, again, we think attractive. We've got a number of different funds that we have which are focused more in the value add space. So at the moment we have funds with focusing on Central Europe, primarily split between offices and logistics. Also across Northern Europe in terms of with a primary focus on Ireland and the Netherlands, with a heavy allocation towards offices, and bits and pieces in the UK with a specific focus on e-warehousing, or retail warehousing as it used to be known.
We're going to talk about e-warehousing in a second. So Mohammed, ESG, is ESG something that you look at when you're looking at portfolios? Is it becoming more of a theme that your investors expect you to consider when deploying capital?
We do. We actually do. We do on just making sure who are we investing with, who our tenants are, and the nature of their business. So it is something definitely that we are always considering in our opportunities.
Richard, I'm going to combine two questions. One from Hassan, again about e-warehousing, which David just touched on, and another anonymous on the retail. So could you give us in 3 minutes or less the whole e-warehouse, death of retail story that as we see it at M7?
So retail is not dead. Let's be very clear about that. It has changed. In fact, if you want to find out how dead retail is, which it isn't, I'd phone Jeff Bezos and ask him to talk you through how dead retail is. He won't be able to answer his call because he's too busy counting all his money. The reality is that what has happened is the way that retail is delivered has changed. So are the shopping centers of the 1970s and 80s valid distribution channels for retail? No. Are retail warehouse parks? Yes, they are. So what we call e-warehousing, other people call retail warehousing, but I've stopped doing that because it gives the wrong impression. The key word in retail warehouse is warehouse. It is a warehouse. Physically, 100% retail warehouses are warehouses. Okay, they're industrial estates that have an enhanced consent, which we call it e-warehousing. And we're able to buy positions at 8-9% yields where true industrial is going for 4, 5, 6. And 8 years ago, it was the absolute reverse. Rents have been reduced. In fact, in many cases are almost in line with industrial rents, and yet yields are high. I'm going to give you one example of just how mad this world has become. Recently, Segro acquired an industrial estate in Canning Town, which is near Stratford, so about 6 miles outside of the city of London. And they paid a cheeky 2.5% yield. That's not a Bond Street shop. That was an industrial estate in Canning Town. They paid £667 a square foot capital value, and they acquired it in £11 million an acre. At the same time, we, M7, acquired into our Box Plus 2 fund a retail warehouse park in Collieswood, which is, for those of you who don't know, it is Wimbledon to all intents and purposes, so 6 miles from the West End. We acquired that at £5 million an acre, so half of the industrial land in Canning Town. We paid £440 a square foot, so 50% less, just on a pure per square foot basis, and the yield that we acquired at was 6.75. So just a ticky 425 points wide. And that is for an enhanced consent. It doesn't make any sense. So, we absolutely believe that e-commerce is going to be the driver of retail for the next 10, 15 years. But we do think that click and collect has got a major role to play in that. And we think that the primary distribution point for click and collect is going to be retail warehouse parks. And if you add into I know I've got a limited amount of time, into the fact that you're never going to get another retail warehouse consent again ever in history. So you've got a fixed supply, if not a reducing supply, because some of them will be lost to higher value uses. And you take into account just how inefficient use of land the retail warehouse park is, because they're all urban infill. The prospects for growth are very high on the capital value side. And B, actually there is huge occupier demand. So the likes of B&M, the UK's largest or most recent FTSE 100 constituent, the Range, the UK's largest private company, Lidl, Aldi, they're all expanding dramatically. So, we believe that to be a very interesting market.
Excellent, thank you. Right, in the 3 minutes that we've got left, I want to...
Can I be really polite? I just want to answer one question, and then I'll shut up and never talk again on this seminar. Just an anonymous attendee here said, could you please provide us with any mistakes?
That was the one I was going to ask. That's what I wanted to ask.
I want to be very transparent. M7 itself hasn't had any terrible investment decisions. However, it was born out of the global financial crisis. And previously, I ran a company called I was the European CEO of an Australian group called GPT Hamilton, and we had a shocker in 2007-8. In fact, I can honestly say that from June 2007 through to early 2009, I didn't make a good decision at all. And M7 was built on trying to understand what we got wrong. And so when M7 started, we had a debt team, because our 3 big takeaways from the crisis were: debt is not your friend, it is a tool. It's like a chainsaw. Use it well, you can cut down trees. Use it badly and it will take off your head. So we started our business with a debt team, and Hugh, who you've just heard about, led that. And from day one, we were very focused on debt. 2, asset management and data management are inextricably linked. There is a total link between the two. So for those of you who know anything about M7, we set up our own data company, Coyote Software. We run our own software. I think, Mohammed, you've had an example of it. It makes what we do much easier. And 3, we are utterly focused on making sure that we protect capital at all times. And as a result of this crisis, we haven't missed a single interest payment, we haven't missed a single amortization payment, and we've continued payments to all of our investors. Why? Because the takeaway lessons of the global financial crisis are absolutely entwined in the very being of M7.
Mohammed, I'd like you to consider answering that question, and I mean, not answer it any way you like, but what mistakes has Camco made, if any, and how have you learned from them?
To be honest, you're smiling now. You're putting me off with your smile. No, no, we did. A little bit of a
tricky question.
No, I can definitely say that we have made a mistake, though it was in a regional investment as opposed to the international investments that we've been doing. We have factored in what we've done internationally, and we try to apply it regionally, which sometimes does not. We've learned that it does not work. With that, and to take that into consideration, real estate is a very localized profession. You need that discipline. You need to have that local discipline in the operations where you're investing in or where you're actually operating. Hence, our relationship, and hence picking and working with M7 in specific locations, as well as our different partners in the US. So yeah, that's yeah.
That makes a lot of sense. David, I'm going to allow you to close out from the panel with a question from me, which is where next in the M7 Camco relationship? Where do you see collectively that going over time?
I think in terms of kind of bringing on 2 points, I think we've mentioned before. I think firstly is to continue and to execute the business plan that we've pulled together on the existing assets that we've bought remains a very big focus for us as a group. I think second, I think we can continue to find interesting opportunities throughout M7's network in the 14 countries that we have. I think we're seeing a few interesting opportunities as follow-ons from the investments that we've done in the UK. And we're also looking at a number of other opportunities in a couple of the Eurozone countries, specifically across the Netherlands, potentially also in the Nordics. So these are some of the kind of areas that, again, Mohammed and his team and M7 continue to look at and look forward to hopefully discussing in more detail in future webinars and releases.
Yep. Well, I hope not hope, but I'm sure there is definitely an intention, I know, from all of us to do this again. So I think we need to draw it to a close. We've run over time. It's 11:32. So a huge thanks to Mohammed and to all the team at Camco Invest who have put this together, along with SJ and our team at M7. If you want to know more about either or both of Camco and M7, you can either contact any of us on this webcast directly, or you can talk to our M7 Managing Director for the Middle East, who is in Dubai, Zaid Al-Rawi. I hope to get him on a future webcast as well, or to go via your normal contacts at Camco Invest. We're very happy to talk to you about any of the strategies that we've discussed today. Then it just remains for me to thank Richard, to thank David, and to thank Mohammed for joining us this afternoon and or this morning if you're in the UK, and to say to everyone, stay well and stay safe. And we hope to see you on the next either M7 or Camco webcast, or the next M7 and Camco webcast sometime in the next month or so. Thank you very much and good afternoon.